Go find your most recent Social Security statement, the one that shows your monthly benefit. If you're already collecting, your bank shows the deposit. Either way, get the real number. Now, do one bit of quick math with me. Take your yearly Social Security, your monthly check times 12, and cut it in half. Just split it down the middle. Write that number down. Then add everything else. Your pension, any withdrawals you take from a traditional IRA or 401k, interest, dividends, a little part-time income, and, this one surprises people, any tax-free municipal bond interest too. Add it all to that half of Social Security number. That total you're staring at? The IRS has a name for it. They call it your combined income. Most retirees have never heard the words, never worked it out, and have no idea their whole tax bill in retirement turns on it. Now look at where your number lands. If you're single and it's over $25,000, or married filing jointly and it's over $32,000, the Social Security check you thought was yours will be taxed. And here's the part that should make you sit up. Those two numbers, $25,000 and $32,000, were set in 1983. They have never gone up, not once, not for inflation, not for anything. Hold on to that. We're going to come back to it. And when we do, it's going to explain something about your money that almost nobody has ever told you. For years and years, retirees were told the same comforting story. Work hard, pay into Social Security your whole life, and the check you get back is yours. You earned it. You already paid taxes on the money that paid for it. That story is not what's actually written in the tax code, because here's the strange thing. Most people figure Social Security gets taxed like everything else, a little off the top, easy to guess, boring. It doesn't. It gets taxed through a hidden trick that does something no other income in America does. It can make a second, totally separate pile of your money taxable at the same time. What that means is there's a zone, a specific income range, where every extra dollar you pull out of your retirement account doesn't just get taxed once. It drags more of your Social Security into the tax net right alongside it. $1 in, almost $2 taxed. Financial planners have a name for this. They call it the tax torpedo. And the reason they call it a torpedo is that it comes at you underwater where you can't see it, and it does the most harm to people who never knew it was there. Let me show you how the torpedo actually fires. Stay with me, because this is the part that does the damage, and once you see it, you can't unsee it. There are two tripwires. For a single filer, the first tripwire is $25,000 of combined income. The second is $34,000. For a married couple filing jointly, $32,000 and $44,000. Below the first tripwire, none of your Social Security is taxed, zero. Between the first and second tripwire, up to 50% of your benefits can become taxable. Above the second tripwire, up to 85% of your benefits can become taxable. Now, here's where it gets expensive, and here's the part the word torpedo is pointing at. Inside those ranges, the tax on your Social Security is building up bit by bit. So, picture a retired couple sitting right in that zone. They decide to pull an extra $1,000 out of their traditional IRA. Maybe for a new roof, maybe a trip to see the grandkids. They expect to pay tax on that $1,000. But that $1,000 of withdrawal also pushes their combined income up by $1,000. And in the 85% zone, That nudge makes $850 of their Social Security become taxable too. Money that a moment ago was tax-free. So now the IRS isn't taxing $1,000. It's taxing $1,850. Now do the math. If that couple is in the 12% federal tax bracket, that $1,000 withdrawal gets taxed as if it were $1,850, which comes out to a real rate of about 22.2%, not 12%. If they're in the 22% bracket, the real rate on that withdrawal jumps to roughly 40.7%. These rates follow directly from the 1.5 times and 1.85 times benefit inclusion math under current IRS rules. Read that again. A retiree who thinks they're in the 12% bracket can be handing over 22 cents on the dollar. A retiree who thinks they're in the 22% bracket can be losing 41 cents on the dollar. On money they figured was barely taxed. That's the torpedo. It's not a higher tax rate on paper. It's a hidden multiplier that quietly doubles what gets taxed. And the worst part? It hits hardest in the middle. Retirees with very low income never reach the tripwires. The very rich shoot right past the top, where 85% is already maxed out and the multiplier stops. The people who take the full hit are right in the middle. The school teachers, the plumbers and electricians, the small business owners, the careful savers who did everything right. If this is the first time anyone's laid this out for you plainly, that's the whole reason this channel exists. Subscribe, and you'll catch the next one before it costs you. Now, back to why that line never moves. But that's not the part that's costing you the most money. The trick itself is bad enough. What makes it really hurt is why those tripwires never move. Because if they'd just gone up with inflation like everything else, most of you watching wouldn't be anywhere near them. So, why don't they move? Here's a question almost nobody asks. Every year, the IRS moves your tax brackets up for inflation. They raise the standard deduction. They bump up how much you can put away. Numbers all over the tax code creep up every January, so that inflation doesn't quietly raise your taxes. So why, out of every number in the whole tax system, did these two, the ones that decide whether your Social Security gets taxed, get frozen? This wasn't a mistake. It wasn't Congress forgetting. The freeze was the plan. And once you see what it was meant to do, the whole thing stops looking like an accident and starts looking like a slow-motion plan that's been running quietly for over 40 years, aimed straight at the people retiring right now. Back in 1983, Social Security was running out of money. To prop it up, Congress passed a law that, for the first time ever, made part of Social Security benefits taxable. Before that, every dollar of Social Security was tax-free. To make it easier to swallow, they said, "Don't worry, this only hits higher-income retirees." And in 1983, $25,000 and $32,000 really were higher-income numbers. Only about 1 in 10 people got caught. Then they did something quiet. They wrote the law so those numbers would never go up with inflation. Think about what that means as the years roll by. Your Social Security check goes up most years. That's the cost of living raise, the COLA. For 2026, that raise is 2.8%. Wages go up. Prices go up. A $25,000 income in 1983 would be worth well over $80,000 in today's money. But the tripwire still sits at $25,000. It never moved. So picture it as a tide. The water, your income, your benefit, the whole economy, keeps rising year after year. But the line in the rock, the line that decides whether you get taxed, is bolted in place. Every year the tide comes up a little higher against that fixed line, and every year more retirees who were comfortably below it find the water now over their heads. This isn't a guess. Government data shows it plainly. In 1994, only about 1 out of every 8 Social Security dollars was subject to tax. By 2022, that had climbed to nearly 2 out of every 5. The net is catching more people every single year, not because anyone voted to raise your taxes, but because they voted once in 1983 to never lower the line. And here's the line from the original 1983 thinking that should stop you cold. The plan was that, given enough time, those numbers would basically stop mattering. That one day, almost all Social Security benefits would be taxed for almost everyone. That enough time? It's roughly now. You are living in the part of the plan where the line catches almost everyone. So, this benefit, the one you were told was yours, already paid for, is not what most people think it is. It was quietly set up to be taxed more and more as the years went by. And the torpedo we talked about? The frozen line is what loads it. Inflation is what keeps pulling the trigger. But the system isn't done with your money yet, because there's a third piece. And this is the one that turns a tax problem into a timing problem that can follow you for the rest of your life. Here's something strange. You can do everything right. Save carefully for 40 years, put the max into your 401k, build a beautiful nest egg, and that very discipline can be what arms the torpedo against you. How? Because the government has a date circled on the calendar, a date when it stops asking you to take money out of your retirement accounts and starts making you. And the amount it makes you take out grows every year, whether you need the money or not. For a lot of retirees, that forced withdrawal lands at the worst possible moment, at exactly the income level where the torpedo does its maximum damage. And most people don't see it coming until the tax bill arrives. This is where the math turns. It's called a required minimum distribution, an RMD. The deal you made decades ago, whether you knew it or not, was this. The government lets you put money into your traditional 401k or IRA before tax. It grew for years untouched, but the IRS was always the silent partner waiting to get paid. The RMD is the day it gets paid. Under current law, you have to start taking these forced withdrawals at age 73 for most people in their 70s today, rising to age 75 for those born in 1960 or later. And the amount you have to take out is a share of your account that grows every year you get older. Now watch how the pieces stack up. You hit your RMD age. The government makes you take, say, $40,000 out of your IRA. That $40,000 is regular taxable income. Fine, you expected that. But it also shoves your combined income up, which drags a big slice of your Social Security over the second tripwire and into the 85% taxable zone. The forced withdrawal doesn't just get taxed, it sets off the torpedo on your benefits at the same time. And there's more tied to that same income number. Climb high enough and you trip into IRMAA, an extra charge that raises your Medicare Part B and Part D premiums. IRMAA isn't a gentle slope. It works in cliffs. Go $1 over a line and your Medicare premiums jump for the whole year. So the same forced withdrawal that set off the Social Security torpedo can also push you over a Medicare cliff and quietly raise your health care costs months later. Here's where it gets stranger still. The exact years when you could most easily take the air out of all this, your late 60s, after you've stopped working but before RMDs begin, are the years most people do nothing. Money folks call them the gap years. Your income is naturally low. You're sitting in a low bracket, often below the tripwires completely. It's the one window where you really have your hands on the controls, and it slams shut the moment RMDs start. Now, there is one piece of genuinely good news, and I want to be straight with you about exactly how much it helps and how long it lasts. In 2025, a new law created a temporary bonus deduction for seniors. If you're 65 or older, you can take up to $6,000 off per person, $12,000 for a married couple where both qualify, on top of your standard deduction. It shrinks for higher earners. It starts going down above $75,000 of income for singles and $150,000 for couples, and goes away completely above $175,000 and $250,000. That deduction really does soften the tax on Social Security for a lot of middle-income retirees. But read the small print, because here's the catch nobody puts in the headline. It's temporary. The way the law is written, it runs out after 2028. And it does not touch the frozen 25,000 and 32,000 tripwires. Those are still bolted to the rock. So, this is a few-year umbrella in a storm that was built to last decades. Use the umbrella if it helps you, but don't mistake it for the storm passing. So, now you can see all three pieces working as one machine. The frozen lines load the torpedo. Inflation and your COLA raises keep nudging you toward the tripwires, and the forced RMDs showing up on the government schedule pull the trigger at the worst possible income level, often setting off the Medicare cliffs behind it. And if you think this is just about your annual tax return, zoom out with me, because this connects to something much bigger than 1 April. Step back from your own kitchen table for a second and look at the whole system, because the picture is bigger and stranger than a tax line. Where does the money from taxing your Social Security actually go? Here's the part almost nobody knows. The money from taxing benefits goes right back into the Social Security and Medicare trust funds. In other words, this is a system that helps pay for itself by taxing the very people it's paying out to. The more of your benefit becomes taxable as the years pass, the more money flows back in. That frozen line from 1983 wasn't just a tax decision. It was a money decision, a slow, automatic way to pull more dollars back into a program that's been short on cash for 40 years and is still short today. And the money trouble is real. The Social Security trustees and the Congressional Budget Office have warned for years that the trust fund savings are on track to run low in the next decade or so, after which the payroll taxes coming in would cover only part of the benefits that are promised unless Congress steps in. Now connect the dots. A program that needs money, a tax trick that quietly grabs more of your benefit every year on purpose, a senior deduction that runs out right around the corner. These aren't separate stories. They're the same story, and you're standing in the middle of it. Now zoom out one more notch to the whole economy. The Federal Reserve fights inflation by moving interest rates, but it can't make inflation go away. And inflation is the quiet engine behind this whole trap. Every year prices rise, your COLA rises to keep up, your benefit number ticks up. And that rising number walks you closer to a tax line that was frozen in place way back in the early 1980s. Inflation isn't just shrinking what your dollar buys at the grocery store. It's actively walking you into a bigger tax bill on the one piece of income you were promised would be simple. And here is the deepest level, the one that's really about your legacy. That traditional IRA, that 401k, the one the government will make you drain through RMDs, doesn't stop being a tax problem when you're gone. Under current rules, most kids and other heirs who inherit those accounts have to empty them within about 10 years, paying regular income tax on every dollar, often during their own top earning years in their own highest brackets. So, the tax you didn't deal with doesn't disappear. It gets handed to your kids, often bigger than it would have been for you. This is the part that changes how you see everything. The choice of when and how you take money out of your accounts, a choice most people make on autopilot or never really make at all, quietly decides how much of your Social Security gets taxed, whether you trip the Medicare cliffs, how long your savings actually last, and how big a tax bill your children get stuck with. One normal, everyday choice, tied to almost your whole financial future and your family's. So let's put the whole machine together, because now you can see every gear. In 1983, Congress drew two lines, 25,000 and 32,000, and bolted them to the floor so they'd never rise. That frozen line loads the torpedo. Then inflation and the very cost of living raises meant to protect you, keep pushing your income up toward those lines year after year. That's what aims it. Then the forced withdrawals from the accounts you spent a lifetime building show up on the government's schedule and fire it, making up to 85 cents of your Social Security taxable for every extra dollar of income, pushing your real tax rate way above the bracket you think you're in, and often shoving you over a Medicare cliff on the way. And the money? It loops back into a cash-strapped system that needs it, which is exactly why the line was frozen in the first place. Meanwhile, the one bit of relief you've got, that senior bonus deduction, is set to run out after 2028, while the frozen lines stay right where they are. Here's the takeaway I want you to walk away with. You were told Social Security was the simple, settled part of retirement, the check that just shows up. It was never simple. It's tied to inflation, to the tax code, to Medicare, to whether the whole program stays afloat, and to what you leave behind. The single most normal choice in retirement, when do I take money out and from which account, turns out to be the master switch sitting behind all of it. And the most important thing about a torpedo you can finally see is this. It has a window, those gap years between when your paycheck stops and when RMDs begin. That's the stretch where you have the most control over every one of these dials. The retirees who get hammered are the ones who never knew the machine existed. The ones who do fine are simply the ones who looked early, ran the numbers, and made careful choices instead of automatic ones. So, before you click away, go back to that combined income number you worked out at the start. Look at where it sits next to those lines. That number is the single most useful thing you can know about your retirement taxes, and almost nobody you know has ever worked it out. If this gave you even one number worth knowing, subscribe. The next videos walk through exactly how to use those gap years before RMDs start. One last thing, and I mean this plainly. This video is for learning, not personal financial advice. I don't know your accounts, your health, your family, or your full picture, and the rules and dollar amounts here can change. Take this as the map of how the machine works, then sit down with a good tax pro or a fee-only advisor who's required to act in your best interest, and run your actual numbers before you change anything. The goal isn't to scare you into acting today. It's to make sure that when you do decide, you're the one steering, not the torpedo.